Hello, I'm Brian Resnick. I'm a senior investment strategist with AllianceBernstein, and welcome to Uncommon Capital, a podcast where we explore the far corners of the private markets and learn important lessons from professional investors. Today, I'm joined by Andrew Deck, head of alternative investments at LPL Financial, the largest independent broker-dealer in the country, serving over 7 million investors and advising on more than $1.8 trillion in assets. Andrew's career is as impressive as it is diverse. He graduated from University of Arizona with a degree in optical engineering and began his career trading mortgage-backed securities for the Federal Home Loan Banks. Since then, he's held roles such as CIO of a family office, portfolio manager across multiple hedge funds, and was part of the investment team at Blackstone's Fund of Funds group. Andrew, thank you so much for joining me today.
You're welcome.
I want to start with your personal journey, and you're not the first engineer we've had on here.
Good.
So what led you from optical engineering to analyzing and trading mortgage-backed securities?
I actually started in finance while I was still in college, before I even finished my engineering degree. So when I was in the Navy, and I got out of the Navy, and I went back to school at the University of Arizona, and I was doing optical engineering, and I was playing golf at the same time. So I worked at this golf course. And one of the members there that I got to know really well was a mortgage bond trader. And at the time, I had dreams and aspirations of playing professional golf like any idiot would. And he would just keep, every time I would sit down for a beer with him, he would just say, come in, see what we do. Like finance is a great career field, all the right things. And then finally, just one day, he just forced the issue. And I went in there and I met with a gentleman by the name of Halbert Lindquist, who is, at the time, one of the senior partners at Blackstone. He had a separate broker-dealer, and we just kind of hit it off at that point. He became a mentor for me. And yeah, it just kind of led to bringing those engineering skills.
So the old adage that golf is good for business is as true now as it ever
Absolutely.
has been.
Yeah.
So I know one of the things you did that was, to me, really interesting was hedging portfolios at Blackstone and their multi-asset team. And if you've been in the business for a while, I think all of us certainly remember the financial crisis. I actually think of all of the crazy things that have happened in this business, it's probably the most memorable period for me personally. And I just wonder, what was that like? What was that like working through the financial crisis and hedging these multi-asset portfolios? Do you feel like there's any major takeaways from that experience?
Yeah, I think in a number of ways. There's one, because that was early days for markets for me. Markets can always overreact in either direction further than you think are possible. There's a lot of talk right now, are we in a AI bubble or something like that? And I'm in town with Christian Kerr, who's our head of macro strategies, and we're talking about it. And we're just like, well, it's still probably 3 to 5 years out, because we have not, this thing can keep extending and extending and extending. Same on the downside, right? Is that human nature takes over, and relating that back to where we are now. And part of why I like the private markets and even the viewpoint of illiquidity within the private markets, right? Human nature, you sell at the worst possible time, right? I mean, most people just sell at the worst possible time, and then they don't get back in until it's too late, which is, I think, one of the benefits of that illiquidity nature of private markets that I like, is you can actually forcefully stay disciplined in your approach because you don't have the liquidity that would let you get out at the wrong time.
Right. So in a way, the private markets control behavior to some degree, and that's positive as well. And that's a great segue into what I want to talk about next. So you've been sort of all over the alts landscape throughout your career, really pretty diverse. And you talk about private markets, and nowadays I feel like alternatives has become almost synonymous with private markets. Having said that, we know that it's a broad universe for many others. So as you think about the world of alts, how do you define alts? How do you think about, trying to get your arms around what makes something an alternative?
Well, you can take the traditional definition, anything that's not a publicly traded stock, bond, or cash, and drill down from there. But for me, and looking at it through my lens, it's really focused primarily on the private markets. And if you look at whether it's private credit, private real estate, private equity, those asset classes are really where the focus is. You can get into other things. And in my role, especially as LPL moves more upmarket into that high net worth space, we're going to have to go there. We're going to have to look more at the commodity space, at precious metals, at things like art and things that the ultra high net worth bring into a diversified portfolio. But where we sit right now, and I think where the industry is, it's mainly just it's private markets is synonymous with alts right now.
So there's nothing necessarily wrong with that. It's just the opportunity set is dominated by private markets effectively.
Yes, I'd agree with that.
And how do you think that's changed over time? Because it wasn't always that, right? Or you have a history in hedge funds, and at one point it was more liquid. What do you think has driven that sort of shift from more liquid alts to being more focused on privates?
Well, look at the markets themselves. I mean, the number of publicly traded companies now versus 15, 20 years ago is about half. So we're down to about 4,000 publicly traded companies. Peak was a little over 8,000 in the late 90s. And the quality of those companies is diminishing. It's not what it used to be. Look at the Russell 2000. Half of those companies, well, 40% lose money on a trailing 12-month basis. Why is that? Well, it's because private equity is picking off the best companies when they're young, or you have these companies that are saying, I don't want to go public. Like, I don't want the regulatory burden or that scrutiny of being a publicly traded company. So I'm just going to stay private longer. And it's completely changing the dynamics, the composition of the public markets. You can no longer sit there and say 60-40 is like this composition of the best instruments in the world anymore, because the publicly traded markets just don't hold those companies. So you have to look for private investments.
So if you want the best investments, effectively, you're cutting off a large part of the universe if you're not looking at some of this stuff.
I mean, if you look at the stats, and everybody defines it a little bit differently, but I think kind of a common number that you can get to is somewhere between 85 and 90% of the investable companies in the US are private.
Wow, that's amazing. And so I guess as you think about this, so you mentioned the 60-40, which is sort of the classic starting point for so many portfolios. How do you think about the role or roles that alts play in a portfolio? And, how do you think about incorporating it or marrying it with more traditional investments?
To me, it's more objective based. Private markets, alts, we need to stop thinking about them as some monolith. Like, private credit is very different than private equity, although when stressed, they're highly correlated to each other. But then you have real estate. You also have hedge funds, for example. Hedge funds themselves are not a monolith. I can bring you hedge funds that are really high risk, high volatility strategies. I can bring you hedge funds that are very low risk, very low vol strategies. When we look at portfolio construction with those and moving beyond the 60-40, advisors, clients, they'll often like the market's up and to the right. Like, why would I get out of equity? And we're not saying get out of equity. What we're saying is shift some of that equity into the private markets. So if you think about private equity, by definition, like, you're sticking with equity. You're just getting that exposure to those private companies, which in many cases are better performing companies. Look at what's going on in fixed income with yields over the past 20 years. And everybody with this kind of desire or need for income, they're going to have to look elsewhere when it comes to yield on their portfolio. Private credit's a great place to get that. So you can look at that somewhat as a fixed income kind of yield replacement strategy. And then if you think about the portfolio construction overall, a lot of these private market investments or alternatives, they're decorrelators. Like, they're gonna reduce the correlation in the overall portfolio.
So basically, if I'm hearing you correctly, alts can be used as enhancers for different components of the portfolio, whether it's private equity enhancing the equity component or private credit enhancing the credit component. You even mentioned lower vol hedge funds, which perhaps can complement core bonds. But at the end of the day, you're not just enhancing them, you're adding diversification. As you mentioned a moment ago, that brings a better distribution of possible outcomes at the end of the day.
Exactly. And if you look at it from like an IO perspective, an investment objective perspective, it can really help you achieve those investment objectives in a much more smooth or positive way. So if you think it's somebody who's fairly conservative, low risk, they don't like the bumpiness of the ride, you can throw something like managed futures and some low vol hedge funds into that equity bucket, and it's going to smooth out your overall ride in that portfolio. If you want somebody that is willing to take a little bit more risk, you've got things like venture capital, growth equity, where you can carve out pieces of that and just, take some real, lottery ticket style plays. And overall, it's a mechanism to help you better achieve investment objectives.
But it sounds like it's not a one size fits all scenario.
Not at all. Even within the space, like I sit there and I say, I don't like talking about alts like a monolith. I don't even like talking about private credit like a monolith or hedge funds like a monolith, because if you look at a private credit market, for example, I mean, the market's probably 40 trillion, but that can be everything from what everybody knows, which is the direct lending space, to litigation finance, to subprime auto lending. I mean, there's all kinds of things in the private credit space that vary in expected returns, in anticipated risk. There's no one size fits all definition for any of this.
And listen, it's been a journey for our industry trying to figure out a way to get alts to advisors. I almost feel like, maybe 20 years ago or 15 years ago, you had alts 1.0 where you had these mutual funds that were alt-like, these liquid alts. And now we're sort of at a really interesting point where you have true alternatives being brought to advisors, which actually brings me to what you're doing these days. And I'd love to talk a little bit about LPL's journey into alts. I mean, you've been at the forefront of this. This is something you're really focused on. Tell me a little bit about how you're approaching that broadly and kind of where you are in that journey.
Well, we're definitely still in the early innings. And I think the key word that you used is it's broad. So we're building into that. And that takes on a lot of forms, but it is working with great partners to do that, because in a lot of ways that high net worth part of the platform is build it and they will come type situation for us. So we really need, and we've been very fortunate to have a great set of partners to work with. They know where we're going and they want to work with us to get there. And that's critical, because in some ways you have this chicken or egg thing, right? If we don't have the platform, we can't attract the clients and the advisors. But until we get the clients and the advisors, if we have this platform, we're sitting there, we're not selling a whole lot of product. So it's that chicken or egg that really puts us in a place where we have to partner very well with people.
And what are some of the things that some of these partners do that benefit your platform, the building? Like, what are some of the best practices for the folks that are working with you, would you say?
I would say that it's a combination of a lot of things. One, it's access to product. So we have access to great high quality product, which is what we're really building our shelf around. The way that I always put it is I want institutional quality strategies. I want institutional quality investments that happen to have a wealth access point or a wealth wrapper associated with them. I want to make sure that the strategy and that wrapper match. I don't want something where, look, there's some, and you know this as well as I do, there's some investments that they just belong in a drawdown finite life. That's just the way to do it. I don't want somebody trying to force a square peg into a round hole and now all of a sudden put this into a liquid or semi-liquid wrapper. It's ultimately going to either dilute the investment or it's going to end up creating a bad investor experience. And that's something, and I don't know if we're going to end up talking about this or not, but that's one of the things we're having to overcome is that first era of alts in retail of bad experiences with non-traded REITs and non-traded BDCs and oil and gas investments that they just went bad. And
yeah, let's talk about that a little bit, because I know when you talk to advisors about alternatives, we talk about advisor adoption being low. Some of it is, as you said, education and knowledge, and I definitely want to talk about what you're doing in that space. But there are advisors that were kind of burned by liquid alts 1.0.
Yep.
That must be one of the toughest parts of your job, is trying to get adoption amongst that group. How do you approach that group?
Well, you have to show them that alts 2.0 or whatever you want to call us. Some people say we're in 3.0 or 4.0. Whatever you want to call us in these days, it's different this time. Part of it is if you look at the quality of the sponsor that's coming into the wealth channel at this point, it is meaningfully different than it was in the past. And as long as it's a case of institutionalizing the retail side instead of retailizing the institutional side, it's going to lead to better outcomes.
So what I'm hearing is what's different this time is really just the fact that in previous iterations, institutions had access to some of the better products, and now they're access points for advisors, and it's really just a matter of getting them on board with that, the idea that they can actually access high quality alternative investments.
Exactly. Showing them that it actually is different this time because of the product.
What do you think are some of the challenges that you're working through today, whether it's selecting managers or the actual technology through implementing or the education? What do you think are some of the challenges that you're really focused on tackling today?
Well, I would say that there's friction in all of those areas. Whether it's LPL, the old school way of doing it was paper subdocs, wet signatures. We've since digitized and moved on to a white labeled version of a digital execution platform, e-signature, all that stuff, it's table stakes now. But that's really reduced friction in the subscription process. That's one part of it. I would say that on the product side, we just talked about how institutional players coming into the space is really helping there. At the same time, just the breadth of product that's out there is actually creating this different friction point, because now, LPL, when I took over this role, we probably had 35, 40 products on the shelf. We're at 85 now. We'll be at 100 to 110 by the end of the year.
Wow.
When I think through our advisor base, for some advisors, that's fine. Like, that's great. It gives them a wide selection to implement a lot of different strategies. For other advisors, particularly ones that we're bringing into the space, kind of starting with grassroots level education and pulling them upwards, it's overwhelming. That's completely fine. So we're spending quite a bit of time on education, as well as we've taken our first step into internal distribution with product specialists that are designed to partner with advisors on their alts journey, help them through things like, hey, I've got this client. I see that you have 40 private credit funds. Like, help me understand this. Help me choose which one I should put into this portfolio, and help educate me so that I can pitch it to the client and get them to understand it.
We do hear about advisors really migrating towards model type portfolios that are easy to rebalance. But at the same time, as the industry goes towards alts, you have the opposite issue. So even if you can get digital signatures and all these things, there still seems to be that hurdle for the industry broadly about bringing these interval funds or these access points into models. How do you think about that? I mean, do you think that the industry will figure that out? It sounds like you're on the road to doing that.
Everybody's on the road to doing that. It's a key to unlocking much broader adoption. And whether it's also in the UMA or as we're moving now into DC, where that's starting to take shape and everybody's trying to figure out, what does private equity in a 401k actually look like? Is it, are you going to end up with an evergreen private equity fund just sitting in your account? Or is it going to be part of a target date fund? Is it going to be part of a broader mutual fund style strategy? What does that actually look like? We're trying to figure all of this out. But what I really hope that we look at is, again, that the industry doesn't try to fit alts into its paradigm, that we sit there and we look at the benefits of alts, or private markets rather, the illiquidity of them, the lower volatility nature, kind of the slower movement of those private markets, and understand that the benefit of these markets lies in those attributes. So let's not try to take something that shouldn't be daily liquid and make it daily liquid just to put it into UMA. Let's make the UMA so that it doesn't have to be daily liquid.
So maybe changing the rebalancing rules to accommodate that and things like that, where maybe every quarter you're not going to perfectly rebalance.
Right. It's just a bit of an understanding that, look, you can have interval funds, the SRPs can lock up. You don't know what's coming from that regard.
So one of the things I want to ask you about is, as you think about this kind of a diverse advisor set, but in general, as you think about more adoption and advisors are engaging with alts, what are some of the biggest mistakes that you're concerned about or that you see out there as advisors approach this space?
I think first and foremost, there's a lack of understanding about alts or private markets in general and what illiquidity means or what volatility means. Everybody wants to kind of lump everything together and say alts are illiquid, they're riskier, and they are not as transparent as public markets. I don't disagree with the lack of transparency. I hope that the industry gets better at that. But there's a cost to being too liquid in this market. And tying back to what we talked about with the investment objectives, or even just the access to the companies, the better performing companies, you can see it with the earnings on the Russell 2000, for example, with all of those companies that are losing money because private equity owns the best of breed from those companies. I feel like when I listen to advisors, it's saying, why would I introduce a lack of liquidity? Why would I introduce illiquidity into my portfolios? I want to respond with, why wouldn't you? Why wouldn't you introduce illiquidity into your portfolios? Most portfolios can handle much more illiquidity than most people think. And there seems to be this misconception that, if I can't sell it on a daily basis, it's this high risk thing and I shouldn't have it in my portfolio. And the answer is no, absolutely not.
So it's almost like you're saying there's another dimension to consider, which is the liquidity dimension of a portfolio. But if you're thinking in terms of being a long-term investor and the fact that some of your investments, whether they're liquid or illiquid, are long-term investments, then it should become less of a factor.
Absolutely. I would challenge an advisor to look at their portfolio and say, what's my average hold period here? And if you think about that and then you look at the liquidity structure of some of these private market access vehicles, you're really not changing much behaviorally from your portfolio construction to put private markets access into your portfolio.
If you put all this together, what do you think the future of alts is going to be in the advisor community? Are you constructive on the adoption of alts?
I think as education improves, as the access continues to evolve, you're going to see more and more private markets in client portfolios, more and more advisors adopting those. And I think it's going to be largely positive. I am hopeful that the industry can police itself better than they did in Alts 1.0, and we can avoid some of these problems that created so much scar tissue that we see now. Because to your point, or to the other side of your question, I think if we have another series of events of products that just go bad, it's going to be much harder the next time to drive the markets.
So some of the skepticism from advisors is a good thing because it'll filter out some of these, or at least hopefully make managers more aware of the quality of the products they're putting out, because, the other side of that, of course, is very problematic.
I hope so. That's really something that I push every time I meet with managers, is that idea of let's institutionalize the retail space, not the other way around.
I love it. I love it. We've talked about a lot of great things. If there was one thing that we talked about that you would love an advisor to take away from this conversation, what would that one thing be?
I'll give you a line that every time I speak at events I use, and that is, to an advisor, I will say, for alternative investments, love them or hate them, use them or don't, you better be able to talk about them with your clients, because if you're not, somebody else will. It's as simple as that. Just you have to educate yourself. You have to understand them, because you have to be able to talk about them. Otherwise, you're given an opening for another advisor to come in and start talking to your clients about alternative investments.
Amazing. Andrew, this was an incredible conversation. I can't thank you enough for sitting down with us today. I learned a lot. I'm sure our listeners learned a lot, and I really appreciate your time today.
Well, thank you for having me. It was great being here.
Thank you for listening to today's episode. Please rate, review, and subscribe on your favorite podcast platform. I'm Brian Resnick, and you've been listening to Uncommon Capital.